Welcome to Total Portfolio, podcast where we talk to leading experts on topics to help institutional investors and private wealth managers make better decisions on asset allocation and risk management. I'm your host, Ronald Lagnado, Research Director at Universa Investments, and today we'll be talking to Nassim Taleb. Nassim probably needs no introduction, but for those unfamiliar, Nassim is a thinker, author, and scholar whose work has reshaped the way we understand risk, uncertainty, and decision-making. He's, of course, known for his groundbreaking books, The Black Swan and Anti-Fragile, among many others. And in his academic career, he has challenged conventional wisdom and introduced new concepts that have influenced the world of finance, as well as the natural and social sciences. Welcome, Nassim. It's great to have you on the show.
Hi, thank you. I'm honored, to be talking to investors after all these years of preparation. But you omitted one thing, that I'm the author of Dynamic Hedging.
Well, I was actually going to bring that
There you
up.
go. That's what how I started. This is
Right.
where I'm ending because I'm getting more and more technical in my work.
And that was the next thing I was going to bring up. So, Nassim, prior to your academic career, you were a successful derivatives trader for more than a decade, I believe.
No,
And I actually first became aware of you in the late 1990s when I purchased your book, Dynamic Hedging, and read it. And I found it was unlike any other book on derivatives that I had read. There was a lot of insight there that I never found in any of the standard books on option pricing. So today, I'd like to focus this discussion on your unique perspective on option pricing.
when people talk about the Black Swan, I get sort of irritated, because I self-identify more with dynamic hedging or its successor.
Yeah. So again, for those that are unfamiliar, this is definitely a book if you're really interested in derivatives pricing. I'd like to discuss some interesting series of papers that you wrote, I think beginning back in 2005, both in terms of the historical perspective you brought to option pricing, as well as how it influences practical applications. And I actually want to try to work that in to tie it back to the topic of tail risk catching. So as I look back, in 2005, you wrote a paper with Emmanuel Derman called The Illusions of Dynamic Replication. And later, you co-authored a paper called Option Traders Use Heuristics, Never the Formula Known as Black-Scholes-Merton. And then finally, which I found the most interesting, in 2014, you wrote a paper called Unique Option Pricing Measure with Neither Dynamic Hedging nor Complete Markets. So I'd like to delve into what was the motivation behind this research, and why is it so important to point out the historical evolution of option pricing in this way, and that in fact I think you're asserting that the Black-Scholes-Merton model was really not the definitive discovery on how to price options.
Yeah, the situation actually worse. I sort of accused Merton, Black-Scholes-Merton, of having caused the crash of 1987 because, part of the dynamics of the crash was people were short volatility, mispricing the tails, thinking it would never happen. And when you have to sell, you drop prices lower, you have to sell more, the situation of negative gamma. The central thing that people don't know is that Nobel or pseudo Nobel in economics was not granted for an option pricing formula. It was granted for an argument, and that argument is that dynamic hedging removes all risks of an option, because we had option pricing formulas since Bachelier, actually before even Bachelier. What Robert Merton did with his colleagues is show that dynamic replication. So in other words, if I sell an option, buy and sell the underlying continuously, I remove all risk. Guess what? In what universe does that happen? In a Gaussian world. If the distribution is not Gaussian, guess what? The argument falls apart. So we had been trading option for a couple of centuries explicitly. Okay. And then suddenly people come up with a formula, and people thought that option trading was caused by the formula. When I was a pit trader, people traded with their hands. They say hands, no sheets. What does it mean trading with your hands? It means you estimate the value of the option based on the price of other option, and they overprice the tails. So what happened is that 1973, you had that option pricing that supposedly was definitive. It's exactly the same option pricing that we had before. They just found an argument for it. But what happened is they imprisoned option pricing in the Gaussian. Now, let me explain what my first argument was. I said people can trade options and have traded options under fat tails. Merton and et al., because it was mostly Merton who did the analytical work on dynamic hedging, embedded that option pricing into dynamic hedging. Dynamic hedging is not possible. I was a dynamic hedger. My book is called Dynamic Hedging. Okay, that doesn't work. We hedge option against option, and you have a smaller residual you dynamically hedge. So I explained that if the option does not include a risk premium for the underlying, it's simply because a put is nothing but a synthetic call, and a call is a synthetic put, and the way they're priced forces you to use a risk-neutral distribution, i.e. a distribution that is arbitrage-based, that includes no risk for the underlying security.
So you alluded to the crash of 1987 as sort of an example of where, perhaps the flaws in option pricing emerged.
Not just that, they had a built-up of risk based on the illusion of dynamic hedging, of being able to hedge portfolios. So people built a lot more risk than ever before in short options.
Yeah, I think I have some firsthand knowledge of that. So there was a firm called Leland O'Brien Rubenstein Associates. I actually worked for them, but several years after the 1987 crash. So they introduced the concept of portfolio insurance, which at the time was an amazing innovation, it seemed. But what we know of it is now is trying to replicate a put option by trading futures dynamically on an equity index. And that was meant to provide sort of an early form of tail risk hedging, although it was sort of replicating a near the money put option on an index. And of course, I don't know if it was ever resolved whether it exacerbated the crash or it triggered the crash. But everybody was basically, as the markets were falling, everybody's trying to sell futures contracts, and the whole thing, came to a grinding halt, and they weren't able to execute. Is that your recollection of what may have triggered the crash in '87?
Well, it's not just them. There were a lot of other short options. You remember there's a company called First Option of Chicago that had some connection with the first bank to be nationalized in Chicago by Reagan, and the banking collapse of '82. And these people were underwater because all the option portfolios were negative. You see, you had a lot of people who couldn't, people don't realize how bloodbath it was from the option pricing, because a lot of people started going on tail options. One, before Black-Scholes, nobody believed, in probability distribution. They went by experience. So they were careful. So that's a central point. But there's another thing about Leland O'Brien Rubenstein that worth mentioning here, is that I remember a conversation with Mark Spitznagel, the founder of Universa. We were discussing in the context of Leland O'Brien, and he said we have hard portfolio insurance. So we made a distinction between soft and hard portfolio insurance. So I don't remember exactly how it was brought up, but we started making a distinction, explaining that what we're doing is a real portfolio insurance, where you buy the hard option. You don't buy the fake option that you replicate dynamically.
So just sort of following up your interaction with Robert Merton at the time. So in that last paper, Unique Option Pricing Measure with Neither Dynamic Hedging Nor Complete Markets, you make a very elegant and simple replacement for the derivation of the option pricing formula that completely bypasses that dynamic hedging argument for which you said they were awarded a prize. Was there any reaction on his part to what you published?
Okay, no, there was a first reaction. The first reaction is I wrote with Derman a paper, because for me, it was natural that a put and a call would be priced off the same underlying security, okay? And if you price off the same underlying security, that security had to be the arbitrage security. And an arbitrage security means that the forward foreign exchange has no risk premium. It's just built by arbitrage from interest rate differential. So in other words, if the currency has 5% and the dollar has 4%, you have a discount of 1% because what you can do is buy currency, store it, cover in dollars, and unwind in a year. So that was a relationship. And we know that since Keynes. Keynes himself, I think Keynes 1921, and it was initially in a newspaper article in the Sunday Times of London, and later on it was an attractive monetary reform. But Keynes had good ideas. Okay, Keynes was different from Keynesians, so so Keynes just say, okay, that simple argument by Keynes of that a forward is arbitrage. Okay, we can use it to show that a forward is nothing but long put, shorter call, European at that expiration. That's the forward. So therefore, why are we wasting time on this dynamic hedging? And the underlying security must be, okay, the arbitrage security. So because put minus it's a synthetic forward. And that was a paper. So Robert Merton read it and got angry and started bullying me and Emmanuel Derman, asking us to withdraw it. Why? He said, yeah, whatever. So I realized, why the hell is this fellow nervous? And he said, well, you should issue a retraction or someone else will do it for you or something. I said, okay. And then there was this article that came out in the same journal by two students at Boston University, visibly not connected to Merton, who was then at Harvard, still at Harvard. And that made the argument that he made to us, and that I don't know how many pages later. And it was bogus. We didn't even answer it. You know, if you've been a trader, you understand these dynamics. But let's go beyond. A fellow friend of mine, who was also a trader like me, and then later on became a professor like me, Espen Hogg, we started reviewing the literature. I'm saying literature since the 1800s, how people traded options, and that's how they traded options. And whatever there was a put, because in many markets with only calls, whatever there was a put call parity would dictate some kind of arbitrage, but there were other arbitrages. Okay, so we realized then that the world, it's not that it went into more and more of a divorce from reality. In other words, you have the academics, they learn from academics, and traders learn from traders. We started having a world in which traders could no longer learn from traders, but they were learning from academics. You see, so they went to University of Chicago, whatever, got an MBA, and learned something instead of learning from traders. So the transmission of these tricks was disrupted. And then the other thing central about the world is that the world was getting fatter and fatter tails, which is a natural propensity of markets to get more concentration extremes. So fatter and tails, while at the same time, okay, people using anti-fat tail arguments. So it really, that was quite an interesting divergence, okay, where knowledge was going in one direction and we're in the other direction. So we didn't have adaptation. Like in medicine, we have adaptation, whereas in finance, we didn't have adaptation. And we saw that soon later with LTCM, and it blew up. And then people then understood our argument that these guys have nothing to do with reality. And blow-ups like LTCM were caused by fake knowledge. They were not caused by anything else.
Yeah, it's just interesting because the firm LOR that developed portfolio insurance was founded by two academics, Hayne Leland and Mark Rubenstein, both professors at the University of California, Berkeley, finance department, and John O'Brien, who is a longtime practitioner in actually kind of a first of financial engineering. So their model broke down, of course, because you could say it was because of the fact they didn't account for the fact that there could be jumps in the underlying process, the equity index price dynamics. The market gapped, and they could not hedge effectively. So what's following that crash for many years, there were papers being published. Did portfolio insurance cause the crash? And there were arguments and counter arguments. And I think Mark Rubenstein wrote a lengthy paper, just sort of doing a postmortem on what happened. I don't remember the conclusions, but the interesting I know because I worked for that firm briefly, in the early 90s, is that they actually improved their portfolio insurance methodology by actually incorporating shorter dated options to replicate long dated options. And what a lot of people don't know is they actually had started that process back in 87 with some clients. And what that meant was that those clients that were holding shorter dated options did extremely well in the crash, whereas the ones that were just simply trying to dynamically hedge a long dated option. You have to understand that what was not easily done back then, because because sort of the infancy of the derivatives market was the idea that you could replicate what they call a perpetual put option on an index. So that the machinery really required dynamic hedging, but they were starting to use shorter dated options.
But let me tell you let me explain first to the viewers and to the audience what they were trying to do. They were trying, instead of buying an option, a hard option, to use the hedge ratio of the option. Just you sell underlying, it's a hedge ratio of 0.4, and then the market goes down, you see. Now you increase your sale, and the market goes back up, you have to buy back. So you get whipped. And net, they say this is cheaper than go buy an outright option. Our point, and again, that's and the fat tails is not possible. You can't say, oh, there was a gap, because the market has nothing but gaps of different magnitude, like levy jumps or however you want to characterize it, but nothing but jumps. And continuous dynamic hedging not just is not possible, but causes feedback loops. You see, if in execution, if I know that every time the market goes down, this fellow in red is going to sell, you sell ahead of him and then buy back from him and keep selling. And then when the market goes up, do the same in the opposite direction. So people got whipped a lot in these markets. So the idea, again, to link it to Universa's business that both you and I belong to, is that there is no free lunch. And number two, under fat tails, these conventional methods are just a waste of time. But let's go now to what happened in 1998. 1998, people say, oh, no, the market had diversion. They just don't realize that these large deviations happen every day. And I learned a lot from old option traders who absolutely had no idea what Black-Scholes was, because they were trading options for a long time. So old option traders, they're used to seeing stocks double overnight from mergers. They're not going to waste time selling calls on a formula when they know the stock can double. They're used to it all the time. So the way they did it is they covered their tail and sold at the money and played games like that. But they knew, about fat tails. But you give them a formula, they become blind to it. A lot of my the discussions in the Black Swan comes from the fact that once you give someone an education, you have an immediate side effect of forcing that person to view the world through that prism. And disconfirmation is very hard. So they look for confirmation, not disconfirmation.
Thank you for that very in-depth description of what went on. So I'd like to move this in a slightly different direction and talk about dealing with options given the reality of the fat-tailed distributional characteristics of markets. So it's interesting, of the many books you wrote, if you have them all on a shelf in chronological order, the first book, Pure Financial Mathematics, Dynamic Hedging, and the most recent book you wrote is called Statistical Consequence of Fat Tails. And so in between, we have the Black Swan, Anti-Fragile, all these things that cover a lot of ground. But the first two to me are like essentially sort of pure in their description of the mathematics, which is directly applicable to derivatives pricing. So what are your thoughts on, what are the consequences of the reality of the leptokurtic nature of the stock market in terms of pricing options? So what in your view is the preferred approach to price options, and under what conditions is it important? For example, is it just pricing deep out of the money options? Where is it necessary really to account for fat tails and option pricing?
I mean, we wrote a paper. You forget to mention a paper we wrote at Universa, Mark, myself, Brandon, and others, on pricing option on the power law. And actually, it resembles what option traders were doing in the past, because it allows you to price an option by extension. Like, the difference between Gaussian and power law is that power law, if I know how many people have more than 2 million and how many, people have more than 4 million, I can easily infer how many more people have more than 8 million, you see, because it is linear and log. So the The same thing applies to option pricing. I can mentally price an option using this extension. It's too technical to do it. Plus, we don't have a board and slides and stuff, and we don't want to bore the audience. But it is a technique of tail extension using power laws, and we make it public. And you can see that basically when people say volatility is expensive, volatility is cheap for that strike, it's meaningless. You have to look on based on a different class of distributions. We were first to start using different classes of distributions in the markets. And why? Because it's very hard. This is why I wrote Statistical Consequences of Fat Tail, to generalize and saying a lot of people tell you, yes, they are fat tails. And then they go build methods built for thin tails, like portfolio theory. Tell you, well, there's fat tails, but let's use portfolio theory. We got nothing else. The point is, if it's fat tails, then every single word in the book Portfolio Theory by Markowitz is it's like fiction. Okay, so if you say it is fat tail, it's like it had a lot of consequences. And I say in this book, it's not like changing the color of the dress. It's going to be white tomorrow. It's going to be pink, but it's the same dress. No, it's completely different concept. You have to view the world differently. And there's things you could do, things you can't do, and so you rebuild stuff based on that, and whether for statistical inference or other stuff. This, in fact, is quite successful a book, because it goes beyond the fact. Yes, we know about fat tails. It goes, what can we do about it, and how should we approach the problem? What works and what doesn't work? What should we modify, not modify? Tail risk hedging is just one element among many, many things. We actually, when we had the pandemic, there's some papers that are not in the first edition that are now, we started arguing with people because the pandemic, they say, well, let's check the track records of predictors of how many people would die. I said, no, you idiots, you don't understand that 95% of observation fall below the mean. So you need 100 years of prediction to figure out if someone is good. And in fact, it's actually 99% for very fat-tailed processes, and ended up being a very fat-tailed process. So a very fat-tailed type of event. So it's the same thing in finance. I'm glad Universa is old now, a firm. The program is old, so we can see more of a track record. Because short term, you can't tell about anybody's track record, because it takes longer to converge than in a Markowitz framework. Sharp ratio, for example, is completely meaningless.
So it's interesting also, after that crash in 1987, that's really where the implied volatility skew actually emerged.
It was actually there before. That's what we showed with when you look at how options were trading in Amsterdam and all of that. It's not a skew. It was, that's the natural pricing, and we call it a skew because using the wrong models. Black-Scholes, when they started using Black-Scholes, okay, they started selling out of money options, and then later on they adjusted, but not enough. And they don't know how to adjust it, just like heuristic.
So there were, sort of in the evolution of option pricing, there were fixes to that, like the local volatility model.
Yeah, exactly. All of these are fixes and patches for to adjust for fat tails. Some of them work. They don't work when you go very far in time or very far in strikes.
In essence, in order to you have to sort of fit a model, whether it's stochastic volatility or local volatility, you fit a model using observable option price. But there's a limit to the price discovery in the extremes in terms of strike. So when you fit these models, you can essentially get the sort of fit the distribution of the underlying within a range bounded by the lowest strike and the highest strike available. So how do you fit, if you're going to explore deeper out of the money, how do you fit the tails?
No, okay. The first thing I would say is that you don't necessarily have to accept the market as being correct. So you tell yourself, based on at the money option value, which gives you the scale distribution, the volatility, so to speak, how should I generate? Either you start with the alpha, which is a tail exponent of that distribution, and extrapolate from that, or use another option and say this is the implied alpha. But when I mean, when I tried to publish the paper, nobody understood it because it was too simple. And then they tell me, what do you do with implied volatility? I tell them, what are you talking about? You're talking implied volatility is one model that only works in the Gaussian world. We're not in the Gaussian world, grow up. But luckily, this became successful outside. I said, after the pandemic, these ideas and techniques became successful outside finance and then come back to finance from the back door. But even then, people in finance have three problems that makes them embedded. The first one is they need a bonus annually. So you have an incentive to sell volatility. It's not their money. Okay, you have no skin in the game, absence of skin in the game, and the frequency of bonus is too short for the properties of distribution. The second problem is that we don't have transmission of trader teaches trader anymore. People go to business school or you got quants who learn from quants. So books from books from books from books. So you don't have a correct mechanism. And the third one, finance is the most difficult of all the application, stochastic processes and statistics in general. So you have here you have a very difficult problem and bad incentive and people trying to game the system. So this is why it was very hard to go against the grain because theories don't succeed in finance because they're good. They succeed because people can use them and self-servingly.
Very interesting. So I want to take this a little further in terms of tail risk hedging, just in a very general sense. So, I've worked in the institutional investing world as well. For a while, I was investment director at CalPERS in asset allocation. So I sort of understand the mindset, for institutional investors. They have their own specific preferences for risk and return, even though there's a required rate of return that they need to meet future liabilities. There's a high degree of risk aversion, and it leads to, including a lot of diversification, dampening volatility. And in the end, that feeds back, I think, and it limits the returns that they're making. I think there's sort of an aversion of doing things outside the box, and that's sort of how tail risk hedging is perceived. And there are other investment management firms that, whether or not they believe that tail risk hedging could be effective, they make arguments against it. We like to call some of these arguments straw man arguments. One is to try and replicate what they think effective tail risk hedging is by some simple strategies of like buying puts that are 5% out of the money, 10% out of the money at some frequency, and then continuing to roll them. And of course, when you do the simulation of that strategy, you find that it looks like while it may pay off in big crashes, there's a high cost associated with it. It's not, so to me, it's what they're demonstrating is that whatever they're trying to replicate is a bad idea, and that's a bad strategy. And we would accept that because of their status, in the investment world. People have come to accept this, and they think that's the reality. So there's that one way of trying to, if I could say it, make tail risk hedging look bad. Another one, an argument that I encountered, by people resistant to the idea of doing tail risk hedging, is that we have the skew in the market. So the crash risk is already priced into the out of the money options. So it's not possible really to add any value over the long run if the market crashes by buying these deep out of the money options. What do you think about that argument, and why is that flawed?
Let me go backwards. Start with the last argument. Someone saying it doesn't pay to buy this argument is falling into the static analysis that was coming from behavioral finance, saying it's irrational, to not take some bets, not realizing the notion of ergodicity. What we call ergodicity, you can call it by any other name, is that what you have to look at dynamically, repetition. And also one of the causes people don't think properly because, again, they don't have skin in the game. They're just managing money and they're going to get a bonus in 1 year, and 3 years will be a different firm. Think about it again. If you play Russian roulette, you may have the edge. Odds are you won't finish the day if you do it every, say, 15 minutes. The problem is stay in the business. The valuation of the option should not be made off of its local properties, but how it confers survival and how it avoids a ruin problem. We shocked the world, and I shocked by explaining that if I give you a 51% bet, I tell you you have 51% against 49 for me, the house, it would be irrational for you to play it. Why? Because there is a ruin problem. Because it's not just one 51 bet you're going to take. It's a series of bets. So unless you have a very, very rigorously defined strategy, you can't take these edges. And likewise, unless you have a very, very, very stringent investment strategy, preventing blow up, there are a lot of investments you wouldn't make, although they have the edge. And at the same time, there are a lot of puts you would buy, although locally they don't have the edge. That just but because of the potential of the market and because it's the price to pay not to be kicked out of the market, you will pay it. So the problem is vastly more complex than seen statically and perceived by the investment industry. I think on the web, there's a chapter of Skin in the Game called The Logic of Risk Taking. And it's in the Skin in the Game, but also on the web on Medium. And I think it's probably the most successful piece I've had on Medium in finance, okay, or related to finance, but it was in general, not just finance, explaining the ruin problem. Sometimes you got to pay to stay in the game. And that price isn't determined by the actuarial value of the put, but it's determined by the potential, what you're going to make in the future. Mark uses the same argument phrased differently in his books, or the same argument, like there's so much money in the future, you want to stay in the game, and that should determine the pricing of the put, not the local property of the put. Again, I mean, the best analogy I can make is that people analyze finance the way they would analyze smoking by saying, oh, the risk return of a cigarette is positive, so why don't you smoke? The risk of cancer is tiny and the pleasure can be high. The problem is we don't analyze smoking as a one-shot deal. You analyze the activity of smoking. And if you analyze that as the activity, you find a complete different optimal result than if you look at it as a simple one-shot strategy. So here I've answered the last criticism, and let me start with the first. The first one is diversification. You don't have to do the simulation. You and I went through to say I was stock versus bonds and all that nonsense. All you have to do is say, are markets fat-tailed? Yes. Is the correlation matrix constant? No. Okay, ignore modern finance. It just doesn't work. You need a stable correlation matrix. And every trader knows that correlation may look like sort of like stable, but at times of stress, you have different correlation, and the correlation structure is unpredictable. And of course, the times of stress are also unpredictable. That changes the whole story. And I remember LTCM, for example, the correlation when they blew up was determined by what they owned. Whatever they owned went down, and whatever they were short went up. The correlation between bonds they were holding and the treasury market became negative because treasuries went up and whatever junk bonds or whatever bond they had went down. That was the stress correlation. It was completely different. And even then they kept defending their ideas, but you don't need that. You just look at the correlation. When you and I looked at the correlation stock bond, we noticed there's only one thing you can say about it, and it says it's bounded by +1 and -1. That's outside these bounds. It was like it's a random variable, and we showed that it doesn't have structure. We showed it mathematically.
Yeah, I think in long-term capital's case, they were relying on this on the run, off the run bond arbitrage, and that relationship that they expected broke down at some point. Because in theory, they should.
But also, there's another feedback mechanism is that when you do dynamic hedging, I think I had a comment somewhere that when you do dynamic hedging, the market will follow the path to punish the highest number of dynamic hedgers. So when you do dynamic hedging visibly, and what they were doing, dynamic hedging means you have stop loss. Odds are a lot of people are doing the same trade, either because they work at LTCM and went elsewhere, they have a friend at work, or because they think the same way. They all have the same stupid education, PhD from University of Chicago or something. Those same stupid PhD economics and finance education, and puff, they come in and they all trade the same way. I think we listed the number of firms that blew up during LTCM, and then you can you also have a number of people who left academia to go to finance, as there's one of them who didn't blow up, and there are very few firms who didn't have an academic connection. Very few firms who blew up and didn't have an academic connection, and or just one academic who didn't blow up during that period, the LTCM phase. And I think it's probably accidental because he does something completely orthogonal.
Well, this has been very interesting talking about your take on options pricing. We could go much farther afield here. I mean, I think we're starting to head in the direction of questioning modern portfolio theory and diversification, how that actually impacts institutional investors. I think that would be a topic for another discussion. Just before we close here, you didn't mention Ed Thorp. It's very interesting because not everyone understands that Thorp, I think, essentially discovered Black-Scholes for Black-Scholes. Is that not correct?
It is correct, but he's not the only one, by the way. Ed Thorp is remarkable because when I wrote the introduction to his memoirs, I realized he's the first mathematician to ever make money because a lot of people, Cardano, a lot of people went to gambling and they went bust. So that was, I mean, it's the first one on record, but he has other attributes. He figured out ergodicity. The Kelly criterion actually inspired by his thing. He worked closely with Claude Shannon. I mean, we're talking about a remarkable person, okay, and who understood these things. So and of course he derived the option pricing formula that was later named Black-Scholes, but he did it properly. This is why I called it Bachelier Thorp. Then I realized that I said, okay, if it's so, actually it's not that complicated to derive it. Someone else must have derived it. So Hogg and I figured out there's the same formula. It was written down the same way several times in history.
And Thorpe, instead of publishing, trying to get academic kudos, actually just put what he discovered into practice. And I think he sort of launched this convertible arbitrage business where he was able to more effectively price the embedded option in convertible bonds.
Yeah, he did. I mean, I'm saying he's a remarkable man who understood convexity, optionality, all of that, way beyond Black-Scholes. And he was also a very accomplished mathematician, by the way. But he said that the only difficult job he had was being head of the math department at UC Irvine, I think. And he was remarkable in many respects, okay? And also in his personal discipline. The fellow is 93 years old and had athletic performance of much younger person. So let's say that when Mark or I from Universa talked to Ed Thorp, there's nothing that contradicts that can, it's a conversation like we're talking to one another, you see. But Thorp definitely, I mean, he was operating in a different environment and operating we didn't have the complexity that we have today. Definitely, probably needs to be associated with that Black-Scholes formula because although other people before did that, he was very accomplished.
Well, it's interesting you mentioned his book. I believe it's called A Man for All Markets. You wrote the foreword to that book. And I had the privilege of meeting Ed at a conference, and I got him to sign a copy of that book, which I had. And then later I met you, and you actually signed a copy of that book as well, having been the author of the foreword. So I have both signatures in that book. I'll see if I can sell it on eBay at some point and make a lot of money off of it. So I think this has been really great having this discussion with you.
Yeah, it is. It is nice to talk about these things, to you about them because you visibly have read the underlying papers.
Yeah, so I mean that was sort of my idea behind the topics for this particular podcast is there's an interesting history here, and sometimes people either are unaware of it or forget it, but there's a lot that can be learned from it. So Nassim, it was great having you on the show, and we look forward to having you back again at some point.
Great, thank you very much. Extremely honored to be on your show.